Welcome to the latest episode of Quest for Twice. Today is November the 8th of 2021. I would like to cover the earning reports from three companies. They reported the earnings last week. They are Energy Transfer, JFROG, and Walker and Dunlop. So the first is Energy Transfer. It reported the earning that was a little disappointing since its EBITDA was 10% less compared to 1 year ago. That was driven by lower interstate transportation volume. Also, there were more arbitrage opportunities 1 year ago from the market volatilities. However, the management was still confident about its guidance given previously about the full year EBITDA range, as well as the implied DCF. So I tabulated the key metrics from Q1 to Q2 to Q3. So virtually this table stay unchanged. The main difference is the continuous debt reduction. Now the net debt is about 44.8 billion. That's almost 6 billion less compared to end of last year. So that's a significant debt reduction. The management also restated its intention for capex in 2022 to be between 0.5 to 0.7 billion dollars. So if we assume its DCF is revert back to 2020 level, that's about $6 billion. Then with the significant debt reduction, the interest paid should be about 10% less. So the DCF should increase by at least $0.2 billion next year. So let's use 6.2 as the assumed DCF for 2022. Then with the $0.6 billion capex and the $1.65 billion dividend, then that's about 2.2 billion. So there will be about $4 billion of free cash flow after dividend and capex is paid. Because of the significant deleverage in 2021, so the management mentioned that they plan to increase dividend distribution and start buying back units in 2022. So to me, that will be significant catalysts to increase the value to the shareholders. Hypothetically, if the management allocate about $2.4 billion for share buyback, so that's about 10% of the current market cap at $9.1 per share. Then, as a result, less shares outstanding, then the dividend payout will be automatically 10% less in aggregate compared to this year. So if the management wants to increase the dividend slightly, then that can easily be covered by the excessive free cash flow in next year. Recall that it will have about $4 billion excessive free cash flow next year. So that can easily cover 10% unit buyback, as well as a 10% dividend increase. So that's why I'm very confident that the energy transfer will do well in 2022. JFROG also reported the strong earning. Now, the management gave revenue guidance for full 2021 about $205 million. So that's a 36% increase from last year. The 3-year CAGR is about 40%. And the net dollar retention ratio is about 129%. So those are all very strong metrics that remain strong. So the key question is, can the fast growth continue? As I mentioned in the deep dive I did last month, the key to that question is about the adoption of the JFROG Enterprise Plus offering. So in the latest quarter, the Enterprise Plus revenue contribution is about 34%. That's up from 32% in previous quarter and 26% at the end of 2020. So we can back calculate at the dollar amount of the Enterprise Plus revenue. So with this rate, likely the Q4 2021 Enterprise Plus revenue will be twice as much as 1 year ago. And the Enterprise Plus revenue in Q4 last year was almost triple of the Enterprise Plus revenue in 2019. So I would say the adoption of the Enterprise Plus offering is still going strong. On the other hand, the other revenue is growing reasonably slowly from one quarter to the next, which is understandable because it's not the main growth driver, and it has already very high penetration in the Fortune 500 big companies in the US. So in conclusion, JFROG, the growth momentum is intact, and with more and more penetration of its Enterprise Plus product, then its moat is going to widen because Enterprise Plus, the main product is JFrog pipelines. That will integrate the full DevOps cycle and makes switching cost much higher compared to the other JFrog product offerings. Walker and Dunlop also provided a very strong earning report. So as I mentioned in the deep dive I did several weeks ago, WD derives the value from the transactions happening across its platform. So the key metric is the transaction volumes. And this graph shows the historical transaction volumes. And 2020 had a $41 billion transaction. And that's a significant increase compared to previous years. And it did even better in 2021. The first half volume was 22.6. That's slightly more than half of 2020. But in Q3, the transaction volume was 18.5. That's surprisingly high, and it's gaining very strong momentum. Also, it's very nice to see the mortgage service rate has been steadily increased. So at the end of last quarter, the total MSR rate is about $114 billion, and that's the same as end of Q2 of this year, and that's up from end of 2020. And because WD gets a service fee about 0.24% of the MSR, then that's a very strong momentum for its service fee revenue to continue. Next is an update on the property sales, which is a key growth driver for WD. So this chart shows the property sales volume in the last several years, and the 2020 property sales value was about $6 billion, and that's a 32% CAGR over 5 years. And it did even better in this year. In the first half alone, its sales volume was about $4.7 billion. And in Q3, its sales was $5.2 billion. So as together, that's already $10 billion. So I would say the WD is having all its growth cylinders working in sync, doing very well in the latest quarter. So now I'm ready to review the revenue from different segments in this table. So this table compares the revenue in the latest quarter with the first half and with the previous 3 years. So the first half revenue was about half as 2020. That's because of much slower growth of MSR. And that deceleration has been reversed in Q3 with almost $90 million of growth in MSR. That's about the same pace as 2020, which was an exceptional year. So if we look at the total revenue for Q3, that's more than half of the first half of 2021, and also more than quarter of 2020. So its growth momentum is very strong, and that's driven by the high loan origination and the debt brokerage fee, as well as the property sales commission I mentioned earlier. This table shows the total expenses for WD and operating income as well as operating margin. So the key expenses standing out is the personnel expense. Historically, has been about 41 to 43% of revenue, but it has increased significantly in recent years, especially in Q3. The personnel expense is $170 million. That's really the lion's share of the total expense. And that's 49% of the Q3 revenue. I'm okay with a quick increase of a personnel expense because I view the brokers also assets because they would generate revenue through transactions. So WD has been investing to grow its broker team, and I'm reasonably confident that the future revenue growth will come following the increased number of personnel. Now I'm going to review the EBITDA quickly because I reviewed this information in details in the deep dive I did several weeks ago. So I'm not going to spend a lot of time here. I just want to point out the 2019 EBITDA was about $250 million and 2020 EBITDA was about $250 million. So in the first 9 months of this year, the EBITDA was about $200 million. So it's almost guaranteed W&D for the full 2021 will have historically high EBITDA, exceeding 2019. So the last trailing 12-month EBITDA was about $258 million. And at the current stock price of $141 per share, the EV over EBITDA ratio is about 18.6. I consider that as a reasonable valuation because EBITDA understates the growth potential as the MSR impacts are removed from the EBITDA. And W&D has been growing its MSR asset very quickly in the last 2 years. So the future growth should be strong, and the EV over EBITDA ratio of 18.6 is reasonable. So this slide was from my deep dive I did several weeks ago also. I did not update it because I still see very little change from my initial investment thesis as well as risks. I see a high growth company that is maybe not as much undervalued as when I first bought it, but I still see it as a good value. And the risks are still about the same as when I did the deep dive. So that's all the updates for the recent earning reports from the 3 companies I own. Until next time, happy investing.